Hello and welcome to the 2026 Outlook from Capital Stewards. Are we in a stock market bubble? Will this cycle be a repeat of the late 1990s tech bust? Prices on everything are up. All you have to do is go to the grocery store to know that. Is your Social Security COLA merely 2.6%? Is that going to be enough going forward? How do you build portfolio income for retirement that surpasses inflation? Are bonds back, or was 2025 just a head fake? These are just a few of the questions that investors are asking as we head into this new year. Welcome to 2026, by the way. And this is our first podcast episode of the new year, so welcome back. Hope you had a good holiday break. In this episode, we're going to share a view on where the economy and investment markets are headed for 2026. As always, these Outlook episodes are a little bit longer, so I know you'll want to listen to the whole thing, but just in case you're looking for something shorter or more specific, check the notes. You can skip ahead to different topics that we discuss. There's lots of charts in this episode, so if you're listening to the podcast version, that's great, but you might want to consider watching on YouTube so that you can see all the charts. All right, let's dive into the economy and markets as we move into 2026. Let's start with what happened so far this year. On the chart, you can see the S&P 500 stock index, which is the red line. U.S. stocks had a great year with the S&P 500 up more than 16%. That's well above long-term sort of average returns. However, gold is up more than 60% for the year, and international stocks, those are up more than 30% for the year. They've outpaced even the bubbly, right, S&P 500 or the bubbly U.S. stock market. So even those international stocks even beat the Mag 7, those large cap AI, hyperscalers, whatever you want to call them. Bonds, by the way, are up 7% for the year. Boring old bonds. Probably, if you're doing normal investment planning and financial planning, they probably delivered enough return for you to meet your investment goals this year if you have reasonable return expectations. So this has been another great year for investors. But most of our clients and most investors in general have long-term goals that extend far beyond 2025 and 2026. The most important factor in investing success is choosing the right assets and sticking with them over the long term. You can see in the next chart over the last 29 years, the S&P 500 is averaging about 10% per year in returns. Stocks produce the highest returns over long periods of time, even when you consider the big recessions and downturns that happened 2001, 2007, COVID in 2020, even a little bit of a downturn in 2022 more recently. Gold returns about 8.5% annually. Bonds just over 4%, all outpacing inflation, even after the recent run-up inflation there at 2.5% a year. So when we zoom in a little bit, look over the past decade, the S&P 500 has returned more than 14% each year on average. Gold's also up more than 14% after strong runs over the last couple of years. And bonds are actually the laggard, averaging just under 2% a year. You can see the drawdown there post-COVID as interest rates have gone up. So when you think about this 28-year, 29-year, and 10-year history, you'd be a very happy investor today if you invested at the peak of markets before the global financial crisis or right before COVID. We'll talk about the current state of the U.S. economy and markets in a minute, but investing solely based on whether or not we're going to have a recession or whether stocks are overpriced and in a bubble is a bad idea. We talked about in the last episode about the accuracy, sort of, or lack thereof, of these kinds of forecasts. Stock valuations were expensive, according to the experts, coming into 2024 and 2025. Now the S&P 500 is up more than 42% since December 2023. So selling your stocks based on a valuation forecast would have led to really bad results. Recession and market downturns don't feel good. I've lived through a few of those myself, but building a portfolio that you can stick with through the hard times is the best way to achieve long-term compound returns. So regardless of the rest of this outlook, think about your portfolio and the other assets that you own and whether you feel comfortable, regardless of the environment, good or bad, sticking with those things going forward. And if you have concerns, it's probably a good time to seek out some professional advice. So let's turn a little bit now towards 2026. In my view, investors are going to face the continuing dichotomy of a slowing labor market and sort of a slowing Main Street economy alongside a boom in AI. Contrary to many of the views that are coming out of Wall Street, there is nothing happening in January of 2026 that's going to magically fix the labor market, make broad business activity speed up, or conversely stall the insatiable demand for building AI capabilities. So I'll unpack this more as we talk about the economy. And then once we have a good feel for where the economy's at, we can talk about various asset classes that we use to build investment portfolios to drive returns in 2026. You can see on the first chart, real GDP, the broadest measure of economic growth, It's projected to finish, perhaps 2.3% or so for 2025. We'll see what happens when the fourth quarter numbers come out. But your perspective on the economy in 2025 depends a lot on where you sit. Almost all of the positive contribution in GDP has come from the CapEx cycle related to the AI build out and from consumer spending that is most definitely propped up by soaring equity valuations that, largely also are related to that AI tech hyperscaler build out. So without that AI and all the related spend, the economy probably would have been pretty flat this year. And that's probably a best case. More likely, probably would have had some sort of a recession in the second, third quarter of the summer. So your perspective on the performance of the economy depends largely on how close you sit to the AI cycle and whether you're invested in it or not. That's why even though the hard data says that the U.S. economy is growing, most people don't feel that way. Most people see the world out their front door, their local economy, and stagnating or contracting, not booming. When you look at all of the consumer sentiment surveys, they are uniformly terrible. So there's this big dichotomy between what people see happening down the street from them and what is happening in a lot of the survey data that we see sort of at the macro level. So what does that mean as we look forward into 2026? Let's look at the labor market. Consumer spending is 2/3 of U.S. GDP, and the health of the consumer largely dictates whether we have economic growth or recession. Not surprising, right? If consumers have jobs, they spend and the economy hums along. If not, well, we usually have a recession. As you probably heard, the labor market is weakening. That's been a constant theme on these podcasts for a while. You can see the chart on the left-hand side. Job creation has slowed dramatically in the second half of 2025. When you take into account sort of adjustments, right? Because we know that these things get adjusted, generally speaking, downward, right? As we get the final data over the months to come after the surveys. The U.S. economy is probably losing jobs every month. You can see on the right-hand side of the page, I try to sum it all up into one graph. Our goal is for the economy to produce enough jobs to stay above that black line in the middle of the chart. And you can see we've been below the line, so to speak, for several months. And again, we think things are probably worse than what is depicted in the data. So that's why you hear about the unemployment rate starting to tick up slowly. So what's causing that rise in unemployment, and should we be concerned? I'm going to make the case that while rising unemployment is a risk, it's not as concerning this time around as you might think. When you look at the overarching unemployment situation chart, you can see the green line is the number of unemployed people. The red line is the number of open jobs. Those two lines now are almost on top of each other. So we would actually say that the labor market is roughly in balance. You can see the blue line at the bottom of the page is flat. That line is the number of layoffs that are happening in the economy. So you can see the number of layoffs is held pretty constant over the past year, despite what you hear in the news, right? This constant sort of pitter of 10,000 jobs here, 5,000 jobs there. We get a lot of layoffs every single week, every single month in the U.S. economy, but we also create a lot of new jobs. So we need a lot of layoffs to move the needle. When we look at the chart of average hours worked across the workforce, things also seem to be stable, right around 34.2 hours a week. So why is the unemployment rate moving higher if the job market isn't producing a lot of layoffs and the hours worked is fairly stable? The answer is new and re-entrance to the labor force. In 2025, we saw a lot of people returning to the workforce. Women ages 25 to 54 are participating in the workforce at record levels. Some of them left the workforce during COVID. They're now returning. The same is true for retirees, people that are over 65. Some previously retired workers are going back to work. All of this is likely a combination, I think, of higher than expected prices, right? When you go to the grocery store, it just costs more to live than some folks expected. And there's also greater workplace flexibility. You get fewer days spent in a physical office location, so that makes it easier maybe for people with small children or for retirees that still want to have some flexibility to live a lifestyle maybe that they want to live and work a little bit as well too. So immigration in the U.S., that's slowed, but we're still adding about 500,000 new immigrants a year, or we added about 500,000 in 2025. So because the labor market is currently in balance, as we add retirees, women, new immigrants back to the pool that are looking for jobs, they're having a tough time finding work and they're becoming unemployed. That hypothesis is backed up by what we hear from companies. There were 142 S&P 500 companies that mentioned something related to having workforce reductions or restructurings during the most recent set of earnings calls. However, most of those mentions were related to hiring freezes or holding headcount steady or constant while they grow their business. All of that adds up to not much movement in layoffs, but again, a tougher environment for new entrants to the workforce or new people that are looking for jobs. Another good way to confirm this hypothesis is by looking at retail sales. Retail sales and U.S. consumer spending in total is growing just above 3%. If the unemployment rate was moving higher as a result of job losses, we would be seeing declines in spending. The folks that were being laid off, didn't have jobs, would stop spending. The folks that are being added to the roles of the unemployed today aren't making money today. Thus, there isn't much of an economic impact when they move from being counted as technically out of the workforce to being counted as technically employed. So let's talk about consumer spending for a minute. While consumer spending is growing, it's plainly obvious in our personal lives and in the data that consumers are feeling the squeeze. In the chart, you can see that inflation's risen almost 27% in total since the beginning of COVID in 2020. For hourly wage earners, their compensation has actually surpassed increases in inflation over time. That's the green line on the chart. But for most middle class workers, they've seen pay increases, but not quite as rapidly as inflation. The broadest measure of compensation is that blue line. While it's up a lot, the employment cost index, that blue line, is still trailing inflation, and it feels even worse than it is. And the reason for that is because before COVID, most consumers, that employment cost index, grew above inflation. So your earnings improved on a real basis. You made more money relative to what your life cost every single year. Now, earnings growth has fallen from way above inflation to trailing inflation. And so that creates a big part of that negative sentiment cycle that a lot of workers in the US are feeling. So spending in 2025, it still rose. There's a big difference, though, between the top income earners and the bottom 50%. Bank of America sees households with less than 50K in income growing spending by less than 1%. So that would be less than inflation, right? And the top earners are growing spending by 2.6%. Even though total spending is still high, volume is slowing down. So that means people, they're still spending, but they're buying less stuff and they're paying more for it. Lower income spending on discretionary items is actually negative in real terms. MasterCard also does a lot of work analyzing consumer spending. They saw a surge in value shopping at off-price retailers. No kidding, right? We know where prices are lower, and that's keeping total spending afloat as well. So consumers are employed and they're spending in aggregate, but they're feeling squeezed by inflation, particularly sort of in the bottom half of the economy. It does look like, though, perhaps there might be light at the end of the tunnel. Over the course of 2025, we finally see inflation slow down, and income growth might be just barely moving back ahead of inflation. You can see on the chart, the red line is the consumer price index. That's what we use to track inflation broadly. You can see that flattening out in 2025, while incomes are still on a modest sort of upward trajectory. If that trend continues, that would be a welcome tailwind for the economy in 2026. On the inflation front, you can see in the next chart that inflation, as measured by PCE, it's moved down significantly since the highs we saw post-COVID, but it's moving slower and a little bit lower, just sort of ticking its way down through the course of 2025. Despite all the political rhetoric, tariffs did increase inflation modestly in 2025, probably about 0.4% or so. Another way to say that would be without the impact of tariffs, my views, and inflation would be in the low 2% range, very close to the long-term target that the Fed has set. Tariffs are going to continue to reduce progress on the inflation front in early 2026. Instead of a one-time bump from prices in 2025, this set of tariffs being sort of implemented and then taken off and then implemented and then changed. Maybe we get a Supreme Court decision and then we have to sort of redo all the tariffs again. It's creating this sort of slow grind of price impacts across the economy. So the impact is less about any one monthly reading, but that impact is going to get felt, over a longer period of time, maybe less in sort of percentage terms, but for longer. So, and you don't have to look, by the way, just at the inflation data to see this. Again, if we go back to listening to the companies that we're investing in, that we're talking to, we listened to their calls last quarter, 35% of S&P 500 companies explicitly mentioned price increases are passing through cost. That's about 15% higher than it was this time last year. So we know that those mentions are probably going to result in higher prices coming in at the beginning of 2026. And they're also largely coming from sectors that are impacted by tariffs: industrials, consumer goods, places that have heavily tariffed supply chains. So instead of inflation rapidly returning to 2%, which it should given the employment situation and the real estate backdrop, we'll talk about real estate in a little bit, I think we're going to kind of have this slow grind of inflation again down throughout 2026, perhaps larger moves towards the summer and the fall after we start anniversarying some of the tariffs. Then I think we can really get humming down towards that 2% mark. I talked about COLAs and inflation adjustments in the upfront section. I think, like I said, I think we're going to see a return to rising real incomes in 2026, particularly in the back half of the year. So if your Social Security or if your earnings are growing at 2.5% or more, then you should be in good shape over the long term. It's just taken us a while to get back to where we needed to be. The last couple of years, we haven't necessarily had that real income growth, and we want to get back to a place where we're doing that. That's what happens when we print trillions of dollars of money in the economy. We get lots of inflation. That has bad consequences, and we're just sort of working our way out of that. So we're in an environment with flat employment, inflation that's moving lower, albeit slowly. And I want to get into physics a little bit here and sort of, I know a lot of you have an engineering background, maybe here in Huntsville. An object that is at rest does what? It stays at rest, while an object in motion continues in motion. So a lot of forecasters, Wall Street firms, et cetera, are expecting a big rebound in the real or the Main Street economy in 2026. Consensus is expecting that AI companies will underperform the rest of the market. I don't see a recession in 2026, but I also don't see a major rebound happening without an action that causes this sort of current low hire, low fire, K-shaped economy to change. The reality is that the risk of a U.S. recession is closer now than it was when investors expected one to happen, incorrectly, I might add, in 2022 and 2023. The action that's necessary to cause that rebound in Main Street economic growth would be lower rates from the Fed and fiscal stimulus from the government in the form of the one big beautiful bill of tax cuts. Ironically, this probably also boosts stock prices, especially in the tech sector. So the Fed would need to cut here at least a full percentage point from where we are today to get rates to a place where they were truly stimulative for the economies. That's likely somewhere in the high 2% range. I'm skeptical that this is going to occur again, given where we sit in the inflation world, like I mentioned earlier. It's likely going to take us a long time to get there. It's going to be a year-long saga, not something that happens in the first half of the year. And remember, for all the discussion about the Fed and the new chair, the Fed's Open Market Committee that sets interest rate policy is not simply a chair that's appointed by the president. There are 12 voting members, and it's clear that some, if not a majority, are very skeptical about future rate cuts going forward when we look at the Fed minutes from the December meeting. So for its part, the administration's OBBA, or the One Big Beautiful Bill Act from the summer, looks pretty well timed. The tax cuts are going to spur companies to invest, and then expanded refunds are going to help consumers spend in the first half of 2026. So that's good because rates are still high, so we need a little bit of help. But the Fed needs to follow through with those rate cuts to keep the economy moving along. Without more stimulus, lower rates, a complete removal of the tariffs, or some other big policy change, then we're going to get more of the same sort of decline in employment growth. And that eventually will start to impact consumer spending and cause problems, if not in 2026, then down the road in 2027. So what does all of that mean for investment assets as we move into the new year? So let's start with the stock market and everybody's favorite bubble watch. Let me be very clear. We are not at the end of a stock market bubble yet. The stock market this year has been driven higher by a narrow set of stocks focused on AI. You know the names: Nvidia, Google, Microsoft, et cetera. So let's look at what's actually happening inside of those businesses instead of just what people are talking about on the news. These are charts that show the cash flow of the companies every quarter. And in the purple line, that's the cash flow that they're generating. The orange line is the capital expenditures that they're laying out to support future growth. Nvidia is now generating more than $20 billion in cold hard cash every quarter than it was in 2021. No wonder the stock price is a lot higher. Microsoft, similar story. Quarterly cash flow is up almost $20 billion. Now their capital expenditures are higher because they've had to buy all those expensive chips from Nvidia. But as you can see, they have plenty of cash coming in to fund future chip purchases and the required infrastructure they need to build out their AI business. Same thing at Google, significant increase in cash flow every quarter. Not every company is this rosy. Amazon cash flow has risen, but not quite as much as some of the other players. So I'll talk about valuations and market statistics in a minute, but it's important to understand that regardless of those figures, the companies that are driving the market are not making fictional profits or seeing their stocks go up on sort of, hope of future growth. And these companies are growing their pile of cash every quarter significantly, unless we do a complete 180 on AI and stop investing. I would expect that growth to continue. Maybe the growth rate slows down a little bit, but it's growth nonetheless. When you look at the forward PE ratios for most of these companies, they're trading in the 25 to 30 times our earnings range, which is pretty typical of where they traded in the 2010s. Nobody was talking about a stock market bubble in 2015, right? So even though the cash flow is very strong, I think the market is kind of disciplining itself. It's not piling into the stocks in a way that creates PE multiples in the 40s or 50s. That would help create a bubble. When we look forward to next year, the AI hyperscalers are expected again to lead the S&P 500 in profit growth. While that growth is slowing down, it's harder to keep your percentage growth up as the size of the company increases. That's just sort of how math works. They're still growing faster than their old economy peers. That slowdown probably will weigh a little bit on share prices. But again, that's where the growth is expected to be in 2026. If we turn to the broader market, U.S. stock returns have been strong this year, and as a result, the overall S&P 500 is trading 22 to 23 times 2026 earnings. Like we said this time last year, that's expensive, no doubt, right? But it's not a high enough valuation for us to be worried about a bubble. In the 1990s tech bubble, we saw aggregate market multiples move above 25 times earnings. Arguably, companies should be worth more now than they were back then because of all that cash flow generation that we just talked about. There was nothing like that happening in the 1990s. It was all speculation about the future of the internet and what it might be. So in my view, the market needs to trade above 25 times earnings and probably by a fair bit for a true bubble to form. You can see in the chart of the index itself and the Max 7 both outperformed an index of equally weighted S&P 500 companies. That just means that instead of weighting the index by market cap or saying we own more of the biggest companies and less of the smaller companies, we equally weight the companies and say they're all 1/500th of the index. The AI growth names are driving performance, and their performance has been much better than the average S&P 500 stock. I think 2026 is going to bring more volatility. Analysts are expecting the S&P 500 to generate just north of $310 in operating earnings per share. So if you put a 2024 multiple on that, you get to 74.40 on the S&P 500. That's up about 9% from today's levels. Lots of Wall Street forecasters are assuming that the S&P will finish next year around 7,500 or so. For that to happen, earnings are going to have to deliver, because I think the concern that everybody's got over a bubble forming is going to keep multiples in check. So I don't think we're going to get another year of strong multiple growth. I think earnings are going to have to come through in order for that to happen. So if we get earnings growth, if we get the rate cuts in the second half of the year that we talked about, stimulus, then we can be okay. For now, I think sticking with growth over the sort of broadening out trend is the right approach. Again, that might change as the year progresses and we see Fed rate cuts actually happen and start to work through the economy, but that takes a while. The big risk for the stock market next year, unsurprisingly, is valuations. Higher valuations create higher volatility. I'll say that again. Higher valuations create higher volatility. The market as a whole has to beat what are already very rosy expectations for upward momentum to continue, and that gets harder and harder to do. And the penalty for not meeting those expectations also becomes greater. We saw volatility increase this year, and I would expect it to increase again next year. That means the returns are not going to be a straight line up. And those peaks and valleys are going to represent opportunities for investors. So when we think about stocks, I also think it's important to think outside the U.S. We talked a lot about this last year as well. Remember, international stocks far outperformed their U.S. counterparts in 2025. That was due to kind of unexpected fiscal stimulus in Europe, the depreciation of the dollar, and some idiosyncratic sort of growth factors across emerging markets that are focused on AI. Remember, AI, artificial intelligence, is not just a U.S. theme. For companies to implement AI, Nvidia designs the chips in the US. They use memory card inputs from Samsung in South Korea. TSM produces all of the chips in Taiwan, and they use machines from ASML, which is based in the Netherlands. So it's a lot of global things that have to happen in order for the AI story to continue. As we turn to 2026, I think growth is going to shift away from Europe, probably back to the US and emerging markets. I think much of the European growth we saw last year was on expected increases in government spending on defense and infrastructure. While that money is not all yet spent, obviously it takes a while for it to get out of the markets. I think it's certainly priced into markets. The dollar is expected to depreciate again, which I think will help foreign asset prices some, but also makes it difficult for European countries to export to the US. So I think we're back to a world where companies in developed Europe simply grow at slower rates than those in the US. Emerging markets, I do think, provide a better source of cheap international stock diversification, in my view. As I mentioned a minute ago, many of the AI players, TSMC, Samsung, are actually very large companies, but they're technically based in emerging markets. China has a number of structural issues. This is not an area where I would simply buy the index. That includes a lot of China exposure in an emerging market index. I still view an active approach as important in emerging market investing. So how you pick stocks in these markets matters a lot more based on historical data than it does when you're investing in the US, where you can just sort of buy the whole market and be on for the ride. Outside of stocks, when stocks are expensive, diversification really matters. And so when we think about investing, the way that we do that is growth, or the equity part of a portfolio. And then the rest of the portfolio is what I call diversification and income. That's not simply bonds, but all of the asset classes that are not stocks that are intended to diversify the risk, that are intended to smooth out the ride and do well when stocks are not doing well. So let's start with gold. We'll talk about commodities, then we'll look at bonds, real estate, and some other assets that go in that diversification income bucket. Gold was the top performing asset class this year by far. It's been on a 3-year run. The price is up more than 130%. There are two primary drivers of the run up in gold. The first is as an economic hedge against unexpected outcomes, right? This is the classic reason to own gold in a portfolio. I haven't forecasted a recession, but we've been teetering on the edge of growth slowing and the labor market weakening for a while. Conversely, if inflation ends up higher than expected and the economy takes off, gold will also rally. So gold's a good hedge in a stagflation environment where we could have sort of either faster growth and more inflation than we expect, or sort of an unexpected recession. The second driver has been global central bank purchases. This is really why we started to build our position in gold a couple of years ago. We've been seeing some slowing in reported purchases by foreign central banks this year. Purchases through September totaled about 250 tons versus 275 tons or so in 2024. It's a lot of gold. And there were more than 300 tons of gold purchased by central banks in 2023. However, I think there was a lot more gold purchased than reported. Some researchers suspect that China has increased its purchases during the fall when prices dipped a little bit and they bought a lot more than they announced. That's not unusual behavior from China. So my view continues to be positive on the gold market. We'll continue to let that play out a little bit. Central bank purchases aren't likely accelerating, but they're staying above their historical levels, and that should support more modest gains in gold prices going forward. So I think both tail risk scenarios, high inflation and the potential for a recession, plus central bank buying remain intact as we head into 2026. So I don't think we're going to get another 60% price gain again, but as a diversifier in portfolios, that is completely okay. Again, what's the role of gold in the portfolio to diversify risk? Outside of gold, bonds and other fixed income assets remain good diversifiers against an economic downturn that's not caused by stagflation. So if the current situation with lower inflation and lower employment simply continues, that should boost bond prices, especially if we get to a place where the economy really starts to slow down and stock prices go lower. The Fed funds rate started this year about 4.25%, and after 3 cuts, it now is just above 3.5%. The U.S. 10-year rate is also lower on the year, moving from just 4.5% in January to 4.2% today. It's important to remember that the Fed largely controls short-term interest rates, but they do not have as much control over the 10-year. The market must believe that the Fed is charting the right course for the interest rate to respond to either lower or higher, depending on the situation. So this is where the Fed needs credibility as an inflation fighter, and that credibility is very important. Regardless of whatever the political pressure is from the White House, that credibility is very important for them to control long-term interest rates. Every president wants to spend more and have lower rates to run the economy hot. It makes them look good, helps them win elections. This story is as old as time. The problem with that is that, as we have seen recently, overspending leads to inflation, and that makes everyone worse off in the long run. So most Fed board members and market participants believe the neutral rate is around 3%. That means the Fed can cut twice more before interest rate policy runs the risk of becoming inflationary. My view is consistent with a neutral rate in the low 3% range. I think inflation, I've long thought, is going to average closer to 2.5% over the next decade instead of 2%, which is what we saw in the last decade. You can see the chart. The economy is kind of settling into an inflation range that's higher than it was pre-COVID. So the Fed funds rate should be slightly higher than inflation, which means 3 to 3.5% is pretty close to neutral. However, the unemployment picture, as we talked about, is getting worse, not better. And the Fed makes changes that impact the economy 6 months from now, not right now. So I think the current environment is going to require the Fed to get at least to neutral, if not going below that 3% range, to keep demand for jobs growing. So that means at least 2 more rate cuts in 2026, but more likely 3 or 4, I think, to get to where they're a little bit stimulative. The implications for investors, though, might be different than you think. So my view, again, is short-term interest rates may move lower. That 10-year is probably going to hold steady in the low 4% range. That means investors in longer-term bonds should be looking to earn their coupon rate, those interest payments that you get every single month or every single quarter, and not for a lot of price appreciation like we saw in 2024 or 2025. In 25, we saw a lot of price appreciation as rates moved lower. The aggregate index is up more than 7% for the year. So yields have been between 3 and 4% this year, meaning about half of the return or more has come from bond price increases as those interest rates have come down. I don't expect that those, that capital gain part of the return to be as much of a factor as we move into 2026. So I would still own intermediate and long-term bonds, but I'm happy earning that 4 to 6% in yield on a balanced fixed income portfolio consistently over time. So for investors that still hold a lot of cash after losing money on bonds in 2022, keep in mind that most money market funds will return about 4% this year. That's about half the return of a fairly standard bond portfolio. So you're materially underperforming other fixed income markets at this point. So let's talk about credit for a minute. I don't see a recession or a major credit event in 2026. So while extra interest earned on corporate debt and high yield bonds is lower than I might prefer, you'll hear that talked about as the credit spread. I still like owning these parts of the market until we see an actual credit problem start to emerge. And no two companies in the newspaper is not a systematic credit event. I would, however, distinguish between public and private high yield debt here. Rates are moving lower, which means investors should prefer owning fixed rate bonds. Most private debt funds have floating interest rates, which means the rate you receive as an investor moves lower as the Fed lowers rates. If you couple that with concerns over credit quality, that really hurt private debt funds in the second half of this year. So disregard the marketing material that you get from your favorite private debt fund discussing how great investing in private debt is and how you're missing out. The only thing that you're missing out on, in my view, is more risk for the same return probably available in public markets. The time to be in floating rate high yield credit was 2021, right? We were having a completely different conversation then. We owned a lot of floating rate bank debt, but we're not in 2021 anymore. We're in 2026. And so I think the time to be in floating rate high yield securities is over. Real estate is another great asset to help diversify stock market risk, especially if you own real estate sort of outside the corporate office world and you do it in the right way. Residential real estate prices overall have been flattish over the past year, up just more than 1%. Of course, the market you're in matters. Florida, the Southeast, where we are here in Huntsville, prices moved up a lot during COVID. That encouraged a lot of new home construction. Now that inventory is sitting around and prices are now lower than they were last year. Markets that didn't see a big COVID boom, like the Northeast, the Midwest, are a little bit stronger. There are two main drivers of demand and prices in the residential real estate market, unsurprisingly: household formation, how many people want to buy houses, and interest rates. Household formation is significantly lower than it was a year ago. That's likely somewhat due to falling immigration, but perhaps also the challenge people see in buying a home for the first time. Why get married and have kids and form a household if you got to live in your parents' basement? On the interest rate front, I think rates are coming down. Again, we talked about that a little bit, although very slowly, right? And that should help people get into first homes. It'll also help the home builders. As long as rates continue to grind slowly lower, I think the housing industry has probably sort of found a floor in here, and better days for the industry and home prices should be ahead. For investors, high rates, though, still make owning residential rental property and short-term rentals pretty challenging. However, I think finding the right distressed opportunities here can, where a particular property can benefit from fresh capital. I think that's still the right approach, same kind of approach we talked about coming into 25. I think there are sellers out there that would like to sell. They haven't been able to do so. And so if you can find opportunities at prices that are flat to down slightly from a year ago, that may be a good time to start investing in a new real estate cycle. The big risk, I think, in the residential real estate market is whether the prices that we see reflected in transaction data are really market clearing prices. New home builder incentives, including those big interest rate buy downs you talked about, they're at record highs. Most new homes are coming with $20,000 to $40,000 in incentives. So that means really the price should be, say, 7% lower on a $400,000 home. House prices are only down 1%. That's a 6% difference. So as long as unemployment doesn't spike and cause a rash of defaults in the new home mortgage market, remember 2008, then I think those homes will grow out of all those new purchase incentives. But if we do have a shock in the labor market and those new homes hit the market quickly, you're going to see a very fast drop in home prices nationally to correct for that. So again, in real estate, be careful about the specific market that you play in and look for opportunities that are insulated from that new home sort of pricing risk that I think is out there. Outside the residential market, I continue to like broader industrial properties, think healthcare, industrial real estate assets. A word on investing in the AI real estate boom. When you invest in publicly traded REITs like Digital Realty or Equinix, you're investing in a real estate company, not a physical server facility. Those companies trade at 40 times earnings or more. Combining that with what I view as a push by the hyperscalers to own their own real estate, I would be careful investing in server real estate as a diversifier to growth stock exposure. Again, this is the diversification part of portfolios, that if we're investing in AI growth exposure in the stock market, and then we're also doing that in the real estate part of our portfolio, then if we have a problem in the AI space, our entire portfolio is sunk, and we don't want that to be the case. We want to be diversifying risk away. So in real estate, I think, again, diversification, commercial industrial assets, healthcare assets, Class A office space, residential opportunities where the price is right. I think those are all the things to look for in 2026. So we've covered a lot of ground. To sum it all up, I view the economy as a continuation of 2025. I know that's boring. It doesn't sell a lot of books, but that's, I think, where we are. I think that's going to be the case at least until rates or inflation are appreciably lower, maybe the second half of the year. I think the K-shape continues, high income and growth-oriented stocks doing well, while the rest of the economy grows more slowly, but maybe steadily in the background. At the beginning of 2025, I was really adamant about diversification because you can find return drivers outside of the Mag 7 tech stocks. You just need to know where to look, right? And we certainly saw that last year. Now with valuations even higher, I think it's likely we see more volatility. We talked about that, more stock market swings in 2026. So again, diversification is really important. It feels like I'm pounding the table on the same topic, but it is so important. You need to look for returns in certain areas of the bond market, real estate, commodities, gold, other assets. We talked about a lot of different things that you can look at and build a portfolio that you're confident will generate returns, even if things don't go as we expect with the AI tech boom. And again, I expect positive things there, but we need to build portfolios that perform regardless of the situation that we find ourselves in 6 months from now. So if you have questions about what all of this means for your portfolio, there's a link in the show notes. You can schedule time to talk. I'd be happy to spend time reviewing your specific situation further. And again, thanks for listening to this episode of the Capital Stewards podcast. Have a happy new year, a good start to 2026, and we will see you next time.